having fun. Feels like a roller coaster. It feels like Friday afternoon and it's merely Tuesday. There's so much going on. Give me a shout if you can hear me as usual, please, ladies and gents. I think we're plugged in and we're good to go. See the screen, see me, hear me. We should be good, but you just never know. Cheers, Marinus. Yeah, crazy days indeed, pal. I mean, I'm just, what's not moving? NASDAQ is. Let's start with the most lame one out there. Never thought I'd be saying this. Yeah, Nasdaq's just tickling up, couple 100 points. Dow just 260 or just they're the boring ones, boys and girls. They're the boring ones. USD, JPY, cable, gold, silver, platinum. Oh man, it's just there's a lot. I mean, listen, it's good, right? It's good. It can be overwhelming if you're not careful. You've just got to stick to your market that you're watching, your setup you're watching. You've got to be careful you're not getting your you're not spreading yourself too thin. What's the old saying? Chinese proverb: "Man who chase multiple rabbits catches none." Pretty true for trading, right? There's opportunity everywhere. Yeah, just pick. I think this is the scenario we're in now is, or the environment we're in now is super high volatility. It's fueled by, it doesn't matter what it's fueled by, but we've just got super high volatility. There's a big macro shifts going on. People are trying to solve those. People are trying to position for those. Obviously, Trump's got a lot to do with that. Obviously, AI's got a lot to do with that. Obviously, the gold and silver rally means stuff. The dollar getting smashed means stuff. The yen move. There's so much to unpack. I think the name of the game for us, we're not investors, we're not long-term players. We are trying to jump on the coattails of momentum or mean reversion or whatever it might be and jump off. And I think there's no better time to do that than now. It can, and listen, if you're killing it, trading your way, do more. But if you find yourself overwhelmed a bit in this environment, just scale it back and say, hey, listen, I have only got to look for these A to B plays. I've got to look for the high probability stuff. The beautiful thing is I've got multiple opportunities in the day. If you're a day trader, in the week, if you're a swing trader, all I've got to do is find a couple of those, and that's good. I'm just going to stack and accumulate and build the equity curve. And if the time's right and you see like you want to hold on to one, then great. But we're having, whips back and forth. It's a little bit cleaner now the past few days, to be fair. It has been a little bit cleaner, but there's a big intraday ranges. Often that doesn't necessarily translate to more profit, right? Because you've got to have a wider stock to accommodate that volatility. But what it does do, volatility, it gives you more opportunities. And if you've got a setup, you've got levels, more likely to have that triggered. So just slowing stuff down, not getting seduced by the big moves, not getting, that's pretty nice over there, and you're trading your market. Stick with the market you trade, even if it turns out that you wish you're in the other market. I think it's better to have the discipline and make sure everything's locked down for this current situation we are in. So, I mean, can I do any analysis that you can't do by yourself? We've got multiple things in play, guys. It's news driven. A lot of this is news driven. So a lot of the technicals are they're useful. Of course they are, because we can see how people are positioning based on price. We can see the pound ripping, we can see the dollar getting smashed, we can see the yen rip, and we can see, one of the things to consider, actually, final point on this, then we'll get going, is to go to the less volatile market. So the market that's perhaps not as headline driven. I'd argue that's maybe some of the indices, maybe, arguably, you can counter me here, but some of the FX pairs are really driven at the moment by this macro sort of themes. Obviously, metal is going nuts. So maybe if you want to slow things down, look for your intraday patterns and stuff that's not so much headline driven. Or if you're doing great and you're actually grabbing on some of these things that are really volatile, do more of it. Because if this is your time and you're doing well, then this opportunity won't last forever. And your job as a trader, I'm talking to people who are doing well here and are putting numbers on the board, is to put the throttle down when things are good. That's the separator. That's what gives you the breakout years. So if that's you, then consider doing that. If it's not you, then you just batten down the hatches a bit, protect your risk, A to B type plays, weather the storm, come out the other side. Okay, who have we got in the house this evening? Fewer than normal. I hope it's not because people have been mucked around and wiped out. Just quick scan through. How are you doing, Arthur? You got Aaron, we've got Amar, got Alana. Good to see you, Andy, Angus, and Barry. Ben, Beth, Bob, I'm skipping through, so if I missed your name, apologies. Emmanuel, Felix, Frankie, Gary, George, Gordon, Isaacson, Jagir, Jim, John, Jonathan, Lana, Lee, lots of Lees, couple of Leslies. Was it the same Leslie? Same Leslie. Marinus, he was the first to put something in the questions mark. How you doing, pal? Pamela, Pat, Peter, Rob, Simon, and Xerxes at the bottom, as he always probably has been since he was at school. Last but not least, Xerxes. Last but not least with the X there. What's this? Multiple echoes. That may, let me see. If you're the only person who's saying that, Leslie, you're saying I'm getting multiple echoes. If you are, generally speaking, I find if you're the only person saying that, it might be an issue at your end. Others are saying it's all good, it's all good. I'm going to make the assumption it's at your end, Leslie. Sorry about that. Maybe logged into it. Actually, you know what? I know exactly why, because I just said your name twice. So, fault finding me. You're getting echoes because you're in as let's say your surname. You're in twice. You've got web and you've got something else that says non-web. So you probably logged in twice somehow. I don't know how you've done this, but that's probably why you're getting multiple echoes, pal. Okay, let's get down to this stuff. Let's get rolling. After I've talked about this, the markets and the conditions. Let's talk today about time of day and new trading models, as if we needed more action and spice. I think it's very apt at the moment, and you know, I'm getting ahead of myself. Let's get going. A great comment here by Seneca, obviously one of the Stoics. If a man knows not which port he sails, no wind is favorable. And I love this quote. I love this so much because, you know, as a trader, we want to plant our flag in the ground and have a North Star of the type of trader we're becoming. It's perfect for these current conditions. Are you trading mean reversion plays, little exhaustion scalps in the 1 minute? Are you looking for the hourly, you know, extensions and momentum? You know, what is the port you're sailing towards? What is your North Star? Because as Seneca says here, if you don't know that, it doesn't matter what the conditions are, you never know what's good and what's not. Perfect for the market right now. If you love volatility, you love these momentum plays, you love kind of looking for this news driven stuff, this is perfect for you. If you don't, then you find something that does suit you. So you have to find out what your North Star is. You have to find out what you're trying to become a specialist in, what you're doing as a trader, because then you know the favorable conditions and all that other good stuff. All right, so as we always have to do, boys and girls, we've got to talk about the risk. If you're trading leveraged instrument, of course, you know this by now. I hope you do. If you're new here, maybe you don't, so it's worth mentioning. Trading leverage, trading margin, just be very, very careful, especially right now when moves are, you know, things get fast pretty quick. You're on the wrong side of something, you're not managing risk, you're trading with leverage, it can get nasty very, very quickly. You can lose a lot of money. Just be very, very mindful of that. It's a double-edged sword, of course. We try to align things in our favor. We want to be on profitable trades with using leverage to our advantage. We want to try to run trades that are working. I talked about A to B stuff, but we're trying to mitigate risk as much as we possibly can. So just make sure you understand the product you're trading and the pros and cons. And, you know, if you're a retail client, if you're a professional client, understand the pros and cons of that type of stuff. And of course, anything I say tonight, just because it has worked for me doesn't mean it will work for you, doesn't mean it will even be a profitable trade in that strategy again. So we're going to talk about some setups, some strategies, some rules and stuff tonight. So it's purely for me sharing with you some ideas, right? You've got to just take it with a pinch of salt and go, hey, maybe that worked then, it might not work now. Maybe it's going to have amazing success. I don't know. That's trading, but I will share stuff with you that I think is valuable for your trading. You can kind of, you know, take it, or you can say, you know what, it's not for me. So this is the final session for January. We're still in our 12-week traders operating system series, which I'm really enjoying, I have to say, and thanks to you guys for some great questions and showing up and getting involved in this stuff. You know, I really enjoy putting these slides together. I enjoy talking about trading. Those who don't know me, my name is Mark Holstead. I've been trading for a pretty decent amount of time, and I like to share ideas with you. I like to share concepts that will help you with your trading wherever you are in your journey. I don't claim to know everything, because I definitely do not. And you never know everything anyway in trading. You know, you could be trading for 100 years and there's still stuff to learn. And that's the great thing about it. It's a never-ending puzzle that you never truly solve. That's why we work on ourselves. That's why we build ideas and plays to kind of adjust and adapt with the conditions. These are unique conditions, right? when I started in 2001 to properly in 2003, but 2001 kind of part-time, they wouldn't have sold the stuff like this. We had times when the Dow wouldn't even move a 100-point range and the spread was 3 points. Super difficult to do anything, just about online trading. So now barrier to entry is so low, you should be careful because it's the mind that you need to get right. Anyway, that's the topic for another time. So we talked about trend momentum, we talked about mean reversion and compression playbooks, we talked about failure and trap pattern playbooks. Today we're talking about news and headline playbooks. And as I've kind of done a little bit before, I'm going to give you ideas and concepts, and I'm going to give you some rule-based stuff as well. But again, past performance and all that stuff, just because it may work before doesn't mean it's going to work in the future. It's up to you to decide what to take and what to discard. Then February, so from next week, we're talking about taking all the strategies. Hopefully you can kind of select some of the ones that you think you have an affinity with and work for you, and we're going to kind of help you decide how to start building the playbook. And the goal of this, of these 12 weeks, is to help you build your own operating system as a trader. And I think that's a really good place to start from, because you want the foundations so that you can weather any storm, you can grow, you can improve. Okay, so let's get down to business. Why does news move markets? The simple stuff first. You know this, I know this, but let's just get on the same page. So news and headlines move markets because they ultimately change people's perceived valuation of the asset class they're trading, right? This is why we get these spikes during things like, and by the way, when I talk about headlines, I'm talking about economic data, I'm talking about non-farm payrolls, I'm talking about FOMC, I'm talking about CPI, I'm talking about PPI, I'm talking about jobless claims, I'm talking about oil inventories if you trade that, natural gas, or anything like this what has an impact on the market. Maybe if you're trading stocks, it will be earnings, anything that has a perceived change in the valuation of that market. I always use a kind of simple example from a company perspective. Even though many of you trade the indices or you trade Forex, that's fine. The same rule applies. If a company is valued at $100 a share, all of a sudden they come out and they say, hey, we've doubled our profitability, and it looks like this is going to stay for the foreseeable future. There's more intricacy to that. You can see why that would revalue that company. So immediately that headline comes out, people's perception is it's not worth $100 a share, it's worth 120 or 130 or whatever it might be, right? There's an instant change in valuation. So we see this in things like interest rates, right? That changes the perceived valuation of the currency that the interest rates change. And then we see things like jobless claims and PPI and CPI, which are kind of second tier data points that ultimately have an impact on the probability of the interest rate changing, which are the big levers that are pulled, obviously, by the government or by the Fed or the Federal Reserve or central bank, should I say, to affect like the economy. And so these little numbers that come out, like the non-farm payrolls, etc., are kind of, it's the pulse of the economy that then traders or investors and hedge funds and higher time frame players extrapolate out and say, that's going to be super bullish for equities, that's why the Nasdaq spikes, or that's going to be super bearish for the dollar, and that's where you see this stuff positioning. And we're not trying to become macro experts here, right? That's not our job. Our job isn't, a lot on this stuff is all purely technical, as I'll show in a moment, but I want you to kind of always go back to understanding, who the counterparty to our trade is. Well, not necessarily a counterparty to trade in this scenario, but why the market is moving. A big, real light bulbs came on for me, kind of, in my 5th year or so, maybe a little bit later, perhaps, proper light bulbs of saying, okay, listen, I understand why price moves. I understand why, how much of an impact this higher time frame has, and why we get these trends, why we get congestion, why we get backfill. The understanding really, I think, is key to trading. And when we're trading news or headlines, it's really key to know, why are we doing that? And we can't always get a clear answer, but just understanding when we see that candle, what does it actually mean behind the scenes? Okay, so that's why news and headline moves markets. So another couple of things to think about. Sometimes we get the obvious things like a rate cut or a massive blowout in earnings. A lot of times it's those subtle signals that I said, which are kind of second tier things, which they can be important. We've seen at the moment, like, inflation's really important, or things like more like tariffs at the moment with Trump, but inflation is important because that is the kind of the driver of the interest rate perception, which is then the driver of the dollar. It's driver of gold, maybe some driven slightly differently, driving some of the bullishness in equities, right? And again, we have to be macro experts here. I'm not trying to I'm far from a macro expert, but a basic understanding of, what is important, getting your economic calendar out, looking at your data points and understanding what might move the market allows us now to kind of to trade this kind of stuff. And the best thing to do is kind of go to the economic calendar, look at the red book stuff, just glance through financial media and say, hey, everyone's looking at CPI this week. Everyone's looking at NFP this week. Everyone's looking at whatever it might be. And it changes from month to month, year to year. It's always going to be changing. And so we kind of want to be, if we're trading headline stuff, and I've got some different concepts for you in a moment, we want to be on something that actually is going to move the market, right? And we're not saying necessarily crazily, because there's strategies to take advantage of different types of movement, but we want something that people are watching, more eyeballs, more positioning, that type of thing. Okay, so I want to, by the way, if you don't think that there's any edge trading headlines, go and listen to my podcast I did with R2 Kokila. He runs the Thales hedge fund, and they've been going for 12 years, not a losing year. And they specifically only trade currency pairs after headlines. So after NFP, after CPI, after Fed, after Bank of Canada, whatever it might be, their edge, their fund's edge is purely on that. So you've got hedge funds over in obviously Scandinavia somewhere, and that's what they do, right? So if you think, oh, there's no edge in kind of trading news, you can go and see that for yourself. Listen to my podcast, go on the tradersmastermind.com website, look at podcasts you find. I think it's on the featured one on the top there, just to kind of go, okay, well, actually, yeah, maybe there is some edge there. I'm not saying you take it, and nowhere near as committed to kind of news trading as those guys are. For sure, that's the only thing they do. But I think it can play a part of, in your suite of strategies, if you like, in your arsenal of strategies. I think this can play a part. Now, you might go, you know what, it's not really for me, I don't like it. But the positives are, when you're going to trade. Like if you're able to get to the desk at 7 p.m., say, for Fed, or you're able to get to the desk for 1:30 p.m. for NFP on first Friday of the month, or whatever it might be, that there might be opportunity there. And so there's a time element that you're trading, which is actually quite advantageous if you don't have all the time in the world to sit in front of the screen. Anyway, let's go back and talk about the kind of risk here. So I want to be clear that, if we're trading the news, if we're trading, you'll see kind of how I bracket things up in a moment, before, during, or after. It's a lot riskier, right? The risk is higher. Now, you could argue that the risk is higher, and that maybe increases the opportunity for more returns. That's for you to decide. But just bear in mind that, whenever you're trading around news, and definitely during news, you're going to get wider spreads. That's not the broker doing that. That's passing it on from the liquidity providers and passing it on from the market. You're going to get head fakes. You're going to get, slippage if you've got resting order, if you've got stop orders in. Liquidity disappears. Sometimes you get early leaks in data, so you can't necessarily time it and go right to the minute. Not very often anymore, but sometimes there's all sorts of things. So just understand there's an additional tail risk in trading around news events that you perhaps don't get when you're trading kind of intraday, the NASDAQ or on the DAX. But don't forget that that's very similar, of course, with all markets, right? I think there's additional risk trading the open, right? The open has a much more volatility, much more kind of price spikes. It's wilder, faster market versus trading midday or trading a different type of market. So you just understand that there's slight differences and nuances here. And if you're nervous of risk, then absolutely, this is the last place you want to be. This is going to be more for traders who just want to add another string to the bow. Like, okay, and I've got some mean reversion plays, I've got some momentum plays. Do you know what? I wouldn't mind a couple of ways to play these headlines, and kind of have some sort of structure of what I'm looking for if I want to go into this kind of headline. Because a lot of people struggle on Fed days, a lot of people struggle on NFP days because they don't really have a structure. They're trying to trade the traditional playbook in an environment that's very, very different. I think that's often the case anyway. And so maybe this gives you some ideas anyway. So I think of it in 3 distinct phases to a headline release. This is the framework that I like to operate from. So we've got pre-news, where everyone's, and this is scheduled news, but it can work for surprise headlines, but you're only going to be the post-news setups here. You're not going to be, or you might have the during release ones. You're going to have pre-news, you don't know when it's going to come. But let's imagine this is for scheduled news events. So you would have pre-news, this is when all the participants are waiting, right? Everyone's like, oh, you know, everybody who is, you know, decent or is not just punting away knows that there's NFP coming at 1:30 that day or tomorrow, or everyone knows that they're waiting for Fed at 7 p.m. Everyone knows there's something coming, right? So all the higher time frame money is waiting, and so the price action, we'll see in a moment, mirrors that, and we can take advantage of that. So that's our pre-news kind of setups block, if you like, and then we've got during the release. So this is the kind of, you know, real, you've got to be very careful here, and I don't want to keep saying it, but I don't want people to think just because I showed some stuff that might excite you that you can go out there and go, oh, brilliant, you know, there's risks with it. But during the release, there's opportunity as well. I think you've got algorithms running wild, liquidity gets sucked out of the book. If you've ever seen a level 2 book during news, it's just super, super thin, which is why we get these price spikes. And then post news, we often get people digesting what's happened and positioning based on that. So think of it in these 3 distinct phases to a release. It's not just after release. I believe there's edge before the release, during the release, and after as well. So post news. So before we get into the kind of weeds here, let's just step back a touch. And you know, I like to do this and kind of have our 36,000 foot view and put ourselves in the mind of, you know, last week we talked about trap traders, right? We said, okay, what are they thinking? What are the participants doing? Why are they acting that way? And how can we take advantage of them? You know, how can we take advantage of their desire to get in or out quickly? Where's the trade based on that? So we're always doing that. We're always thinking, what are the other players thinking? What are the higher time frame players thinking? What are the bigger players thinking? Institutions, trap traders, etc. And so if you think like a hedge fund here, and what I mean by hedge fund here is maybe an investment fund who's, you know, trying to outperform the S&P 500, or not a quant firm, or not a firm specifically trading over news like the guy I talked about before. Think about like high time frame money trying to put capital to work. They don't want to guess, right? And they are, from game theory, they are more incentivized to be late and get a worse price and justify the decision than guess before the news release comes out. So let me give you a kind of example here, and it will make sense in a moment when I share some strategies with you. And if you've got to deploy, what numbers are we talking about? I don't know, £1 billion. Let's say you've got to deploy £1 billion, right? And you are making a decision whether to buy, and let's keep it simple, like NASDAQ futures, okay? So just keep it stupidly simple for now. Maybe $1 billion is too much, but it doesn't matter, right? Now, you know that there is federal interest rate decision coming up. If you deploy that money now and you're wrong, you're going to have to justify to your investors why you took a punt. Why did you take a punt when you knew Fed was coming out? Why did you deploy that capital before that news release was coming that you knew could affect the market? You're fired, pal. You're an idiot, right? There's a consequence to that. And if they get it right, they go, okay, well done. You know, you made a bit, you were right. You got the direction right. It came out in your direction. Well, good. Has a pat on the back. But the consequences far outweigh the benefits versus waiting for the news release to come out and then positioning. I mean, you'll be at a far worse price, right? If it comes out and the NASDAQ suddenly spikes 2% and then you buy, you can justify it and say, well, the Fed did this, the language was this, so we thought to position because of that. And if you're wrong, it's like, well, we've justified it. If you're right, great. You can see why not many people want to position and gamble before kind of big releases. They want to be able to justify the trade. So that's why we think about this pre-news setup. So what's the behavior of price? If you've ever traded during news, I'm shuffling around in my seat trying to get comfy. If you've ever traded pre-news, you know how this works, right? The price often drifts around. It has a little push to the high side. It stalls. It comes back. It rotates around a mean, hugs VWAP if you're a VWAP trader. And like I say, no one really wants to position. And so this is when we go, okay, and our job as a trader is to try to map the strategy and setup to the conditions. Okay, and we've always talked about this from day one. Momentum models, we want to find, you know, explosive moves that are breaking out, volatility is expanding, you know, trend stuff. We want to find those chugging trends. You want to try to use the right tool for the job. And so what this does is we know the participants are waiting for news at this specific time. So our assumption is, hey, price has got no real reason to be aggressively whipping around here because most people are waiting to position after the news has come out. Now, you do, of course, get exceptions to the rule, as you do with all trading. Sometimes you might get a time pre-news where the market kind of grinds up and grinds up and grinds up and grinds up or grinds lower. You might get that, so you don't trade it that way. But if you get a market that's just sitting there, oscillating around, doing nothing, use your advantage. Say, my expectation is we're going to continue doing this. No one's going to take a big commit. We're not going to break out anything until we at least get the news release. Okay, great, game on. Let me start to trade mean reversion until that news release. So we'll do stuff like VWAP extensions, Bollinger Bands, if you like, that type of stuff. And we'd use like ignition bars, wicks and tails, and this type of thing together. And let me show you kind of some examples here. And by the way, I pulled these from my playbook. These are some of the screenshots I've had for many, many years. I can't remember what these are from, 22, I think. Oh yeah, 22. Just to show, and I mixed them up as well with some current ones, just to show you that this stuff is reasonably timeless. Obviously it doesn't work all the time, nothing does. But the idea and theme is that, often we get this concept of the pre-news lull before something happens. And so if you've got an impactful data, everyone's waiting for that. The more impactful the data, the more meaning it has, the more likely the market's going to be range bound, ping-ponging back and forth. And so we get just a slow rotational market stretching away from VWAP, double tops, ignition bars back to VWAP, just the classic stuff that we talked about week 1. Do we do mean reversion? Week 2 maybe? So it's that type of stuff, but now we're mapping it to the type of environment that is more conducive to work. And in this example, Fed comes out and off we go to the races, and then it becomes a during news trade, which we'll talk about in a moment. I've got some good rules for that. So, we want to use the fact that it's going to be quiet, it's going to be mean reverting to our, why did I do that? I don't know, to our kind of advantage. Same here, NFP came out with this random screenshot that I pulled from my folder, my playbook folder, ping-ponging around. You've got a Bollinger Band there. If you're that type of trader, you can see, I'm not here to say, I'm balancing this. You're going to have some rule-based stuff in a moment that I'll give you, but this is kind of concepts. And I don't want to cover old mean reversion stuff we've done. I think the recordings are up on that. So the idea is you use some of that type of stuff in this environment before the data comes out, if you're a day trader, because your perception, the assumption is that's going to continue until the data comes out, then all hell is going to break loose. So that makes sense. Okay, so something that you find a bit more interesting, perhaps. During the release. So this is where things get spicy. And again, I will say at the final time, but this is where we get into the real risky territory stuff. Because your discipline's got to be on point. You got to make sure that, you've got your connections right. Everything's got to be really, really good. A horrible story of being in the DAX trade many years ago. And I don't want to really give the numbers out, but I was up a really significant amount on the trade, like really significant for me at the time. And it was still a really decent chunk of money because I've been adding to this DAX trade, Market then one more spike, and I'd fully loaded this boat, and I was like, that is I went to take the profit, and I couldn't get out. It was something wrong with the computer, something wrong with the internet connection, something wrong with the whatever it was. I couldn't get out, and I watched all that profit disappear, and it went the same amount against me. So the amplitude of the move was, obscene for me at the time. Ultimately, it kind of came back, and I got out with like less than 10k loss because I was in piecemealing out. But the point why I'm telling you this is that this is when things can get nasty very quickly. So just make sure you're protecting your butt. Make sure you're protecting. You've got your redundancy sorted out, all this stuff. So if you decide to trade this way, okay, let's go. Liquidity pools happen all the time during the release. We talked about to get a predatory algo battle. So it's when algos just want to snipe each other off, and you get price spikes. But most of the time, expectations are met. So what I mean by that is, if you're expecting a number of jobs, if you're on a payroll number, it's probably going to be close to that. Or most of the time, there's an expectation of what might happen, and very rarely. And also we got to be very careful about timing this with a data point that is not so exciting. It's just a typical data point that actually, people aren't going to get crazy about. It's not going to go too wild. So one approach to doing this is my least favorite of the two, by the way. I've got two for you. My least favorite of the two, but now and then I kind of wheel out and go, I think this is the day to do it. Is we do a lot of research, and AI helps us do a lot of this now, and we study some past reactions, and we say, hey, what has the market kind of done? You know, when the price comes out, it whips up and down. What's the typical range of that for NFP? And we go back and we use AI for this, we use TradingView, and we say, you know what, it's about 200 pip range. And so what we do then is we say, right, typically that's what we're expecting. There's not a data point that is really key and is kind of going to just whip off to the, you know, we've still got some tail risk here, but we actually consider, you know what, this possibly could be something that is just going to be a bit noisy and may just settle back where it is. So what we want to try to do here, we want to take advantage of these algos and liquidity vacuums by putting resting offers and resting bids down here to capitalize on that whipping noise. Now, the downside, of course, is it just comes up, runs through, stops you out. However, if we're strategic about where we put these bracket orders, then the idea is we just get caught, it comes back, we come out, and that's the most likely scenario that we're aiming for, with an occasional time where we might get that goes against us, but the target's 1R, you know, we might get caught out now and then. So, you know, this is about timing as well, and we want to kind of do it with something that's reasonably people are looking at, but it's not a case of if it's this or if it's that and people are 50-50 and they're all balanced, like is it going to be a quarter, is it going to be half cut type of thing, because that's when you get these really kind of explosive moves and it's not really the strategies to be deploying. And like I say, the risk of this is it just comes, rips straight through. That's why you got to have them quite far away, because you want to take advantage of that little snap up and come back, and you've got to go back and kind of do some research to find out, you know, what your expectations of this. And also, you know, you don't want to be doing this with any decent sized clip, man. You just don't. So, if example here that you wouldn't have got filled on. So, 200-point range on the Nasdaq. So I'd put a bracket 100 points above, 100 points below. This wasn't anything big. I think it was it PPI? Might be PPI rather than CPI. So it wasn't anything like really major. It wasn't one of the ones that everyone's looking at either. So I thought, you know what, if we get a little spike up or a spike down, this is the sort of thing you'd get. So you leave your orders in, you sell limit there, you buy limit there. The release comes out. In this case, it was pretty benign and it got like a 60, 70 point spike. So you wouldn't have been filled on this. And that's fine, because you're not trying to get filled, you know, at a low price, because that's when the risk is high. You want it so it just catches you, snags you, maybe goes on, you're never going to get obviously the tick, and it rolls back and you kind of come out. That's the objective of this. And you're bracketing two levels. Now, in a perfect world, which happens very occasionally, and it's very nice when it does, the market will ping up, take your sell, ping down, take your buy, and like, oh, thanks very much, call the whole range there, and then do its thing after that. That's rare. Most of the time, you don't get filled. But if you do get filled, then you kind of can manage it. And again, you've got to be pretty on the ball here with how you manage this type of stuff. And when the release comes out, very often you then want to kind of put in a stop. I would always say, kind of generally speaking, have some kind of stop in place, wide stop, that you can then drag down if you got filled, so that you're kind of catching, because these things whip quick, man. This is like a really quick mathematical probability based trade that you're relying on, you know, prices whipping, coming back, and you're trying to time it with the scenario that actually is not going to be kind of blowout number. So this is one thing. It's not my preferable one. It's just I've got a better one for you in a moment. But it's something that you can wheel out from time to time. Don't do it on kind of heavy decisions, election results, clear two-sided risk stuff. You just want to do it on a normal, benign, but interesting number, like a red book number. Okay, the announcement trade. This is a nice one. I like this one, because it's very, very methodical, very, very strategic, very rule-based. You know, your stop is not a crazy risk on it. Okay, you got to also be mindful that you're trading over news, but you're kind of letting the dust settle a little bit. So let me share this one with you. We're trading the overreaction, but we're not trading the algo spike like we were with the bracket strategy. With this way, we're saying, okay, the announcement trade here is that we want to look for the overreaction, and we're going to play that if we see something happen. So the idea here is we see the market overshoot in one direction. We then, after we frame that with the Fibonacci tool, I'm going to show you in a second what, and the reason I use Fibonacci is we want the 50% and the 75%, and that's all we want on that. And you'll see why in a moment. And what we're doing here is we are waiting for the market to gap up and reverse. Let me show you example with better. One from the playbook, and I've got one from recently as well. If I show you the recent one first, I'll show you the recent one first. Here you go. So this was NFP. So the idea here is that price spikes up. So we bracket from the open to the high with our Fibonacci tool, and we say to ourselves, okay, listen, this has gone for a reasonable amount of time, but actually if it comes back more than 75%, so from the high to the opening print here, where the number came out, if it comes back more than 75%, then we initiate a short position through that, and our stop goes at 50%. So we, as the price starts to go up, we start expanding the tool out, building the tool out, and then when it finds a top, we've got our levels. So about here, we kind of know where we've framed the trade already. We know, hang on a second, it starts to go through here. So that's 49,596. My stop's going to go here. You work out mentally what that is in numbers. You go, right, that's this, how much size I want to put on, okay. Now, traditionally, you've got two ways of exiting this. One is you exit a one-to-one when it comes back to the 0 point on your fib. I've got this wrong around, we get the point. Or you trail the stop above the high as it high the candle as it comes down. In this case, your exit would be here. So your 50% stop is there. Your trigger comes through as it comes back through the 75%, and you can frame this out. There's no rush with this. You don't want it kind of too late in the day, to be fair, but you're not kind of trying to catch these volatility spikes here. You're kind of waiting for the extension one way or the other and saying, if it reverses, if this is just people, then I'm kind of using the trap mentality here to kind of position the trade. Example here is kind of some of the ones from the playbook from that I've dug out. You've got yen, you bracket in it, you take a short of the 75, your stop would be here. And if you're trailing it down, you're kind of out here. Another one here, what's this? Pound dollar, look at the price of this one. Same type of thing, spikes up. Okay, great. I don't know why. You don't need all these on the fib. You just need your 0.5, 0.75, etc. As it comes down, there's your trigger. And in this case, you're either out here or you're out the one-to-one. Hopefully this is making sense. Dow, you got the spike, you bracket it, comes down. You go, okay, thank you very much. It's coming through 0.75. My stop goes here and my target's here. So it's quite clinical. It's quite an easy trade to take. If you like to trade around news events and you want some structure, it's not a bad way to kind of approach things. It's not, nothing's perfect. There's never going to be a perfect way to do it, but, and there's some adjustments and stuff you can improve this for sure. But it gives you the idea here is you're saying the market is overstretched in one direction. It's had an overreaction. I want to trade that overreaction. I don't want to try to be smart and time the top of it because you find it is hard, tough to do. So this is a way of saying, if we come back 75%, my expectation is we come back the whole way. But if we don't, I'm only going to risk kind of quarter of the move, and that's my target or my first target anyway. So it's kind of okay in terms of risk reward because you've got the potential of being an absolute trap and a real reversal, and you know where your stop is. You kind of can play things out quite cleverly with that. Okay, so let's talk about post news. So once you've had once you've had the news release and stuff has come out, you've got three outcomes, and this will help you if you're trading, not interested in trading news, not interested in the pre-news mean reversion, not interested in the during the news plays. You're like, okay, I just want something to guide me and help me get a better framework and foundation for trading after news events, right? There's often three things that will happen. One is a reprice and expected price response. So what I mean by this is, if the news is bullish, and by the way, sometimes if you don't know this, and there's no rush with this, use ChatGPT. Use, say, hey, this is, and you can get all this, the news comes out and you can kind of cut and paste and say, what does this mean? Is this bullish for NASDAQ? Is this bullish for gold? Whatever market you're trading. If you don't know, that's okay. So you just want to know what is the default setting here with this. And if it's bullish news and you get a move to the upside, that's what I call expected price response. So in other words, a reprice scenario, let's go back to the initial example. Suddenly the company reports twice as good earnings, profitability, whatever number you're looking at as it had before. Well, that's bullish. And there are anyone's kind of metrics that bullish. There are some complications sometimes with other things in the mix that pollute that number, but let's keep it simple for now. That's bullish, and price would go up. That'd be expected response. So bullish news, price goes up, expected response. The reaction from you as a trader, I believe, should be you wait for that reprice to be confirmed in a chugging, persistent trend rather than those emotional spikes. And then you start to play the trend game of your flags, your bull flags, the little traps below, kind of any pausing pattern pullbacks. then you go, right, I'm in that mode now, but I've seen a revaluation or perceived revaluation of the asset. I've seen the response as expected, i.e. bullish news, it going up, and we've got into a grinding trend. Okay, how long have I potentially got off this trend? We've got 3 hours to the end of the day. Okay, I'm going to start to position for a pullback. That's a good way to structure it. The second way is you get the reprice, but it's an unexpected price response. So this is often where you get the trap first and then the reversal. But unexpected response means it's bullish, but actually you get a bearish response to it. That's one of the best trades, I think, because you get a lot of confusion. Very often you get the market kind of goes bullish. Oh, it's great news. It rallies, and then all of a sudden it's just, a rug pull. You've got all the people who are scratching their heads. There's a much more sense of urgency there. The unexpected price response is, one of the best plays you can take when everyone's looking, thinking it's great, and it doesn't react as it should. That's when you can really jump on the kind of moves then and kind of get some squeeze to the downside. I won't bore you with this story. I've told you this before, but one of my first exposures to unexpected response was everyone was piling into this oil exploration company, and this was kind of early days when I was trading all sorts of different things. And I bought this company at kind of 3p, 4p, 5p pennies. I think it was maybe up to 9p. Anyway, the point is it rallied, and everyone was saying, they're doing an oil exploration. They're going to get the results of this test, see how much oil there is in the ground they've got the rights to. And this thing's rallying. It got up to 18p. It basically, multiple hundreds of percents from where it had been. And it's bulletin board form. Everyone's sharing, how it's going to, when it comes out, they're going to find all this oil, and man, it's going to be £1. And everyone's going, oh yeah, look how many shares I've got, and this is going to be great. Came out, the report came out. It was brilliant. The report was brilliant. It's like they found so much oil, all these barrels of oil. Everyone's working out and posting, wow, look how much that's worth. And initially the price spiked. Everyone was like, yeah, here we go. And then it started falling, and it went back through the open, and it just fell like a stone. And I'm just going, what? And everyone's posting, saying, I'm buying more. And it was nothing to do with the fact that the release wasn't bullish. It was super bullish for the company. Right? The company's going to do very well. But everyone's loaded the boat long. There's no one else to buy, especially in that kind of small environment. And so where else could it go but lower? The buying had caused it to rally up to kind of multiples of its lows. And now there was no one else to buy. And institutions didn't give a toss about this type of thing yet. So you had no more buyers. So that's a interesting story from a small cap perspective. But you get the same type of thing with the larger caps, in that if everyone's positioned and everyone's bullish, and the number comes out, it's great. It was like, yeah, it's great. And then everyone looks around and goes, well, who's left to buy? I'm not buying anymore. And it starts to roll over. Everyone then is scrambling to get out of a very small door. That's a nice kind of post-news trade potential. And the other thing you get is no reprice, resume prior market rhythm. So often if you've had a grinding uptrend, you don't get a very significant news release. You get the resumption of the trend. So very often it will do that. It will pause for the news release if it's one of those days where it has been grinding, and then it will carry on continuing. Or it's just a little bit of a shudder, a little bit of a look around, and then a sigh of relief when there's no panic, so to speak. And then often it kind of continues on its way. My least favorite of the three, if I'm honest, because they're hard to time, but they're there, and it's a good framework, I think, to use. All right, we've done it all. We've covered it all. Yes, I've kept on time. Lots of stuff there. Find a lot of stuff at you. Hopefully, it helps you think a little bit more clearly about you're trading around news. Maybe it's for you, maybe it's not. I say the caveat there of there are some risks involved, but I think there's something there for everybody, regardless of what you trade, and you can reduce the risk. Never eliminate it, of course, but you can reduce the risk down and trying to pick the things that aren't that extreme. Wait for things to settle, not get involved in that kind of algo thing that we talked about, unless that's really your thing. There's ways that you can reduce the risk on it, but I do think there's a lot of opportunity around news, potential opportunity, not always, but potential. And if you have it as part of your playbook, then like I said, the way you operate is you say, okay, well, I've got news coming out this day. I'm going to make sure I'm at the screen. I'm going to decide, yeah, I'm going to look for this, this, and this. And it becomes like a very focused energy and effort into a specific time of day, a specific day as well. And then you find your trade or you don't, and you walk away, as opposed to waiting for the trade, putting your levels in, putting your alerts in, which is a very different type of trade. So it might be something to consider, or you might be like, you know what, Mark, it's not for me, pal. I'm happy doing whatever I'm doing. In which case, you know what, maybe that's good, because you kind of listen to other things and you decide to stick with what you're doing. All right. let's have a look. Is there any questions? I feel like this is a different topic than the normal stuff we cover, and that's why I did say I think this is more slightly advanced, but I wanted to cover it because I think there's value here. Okay, next week we're going to go how we really define type of trader we are, bringing those strategies, all the stuff I've fired at you. You can also go to the website. If you go to tradersmastermind.com, I've tried to collect a lot more of the strategies and define them and put them on there. So you click trading strategies, we've got the Wyckoff stuff on there. We've got loads of things. If you want to dig in and kind of say, I want some more strategies and some more rules, then do that. That will put you in a good position then in February when we try and distill it all down to create the trader operating system for you. Okay, so let's start here. Rowie, good to see you, buddy. Sukhvinder, where do I get the previous webinar recordings, please? If you registered, they will be sent to you after. If you didn't register and you're brand new, if you go to tradersmastermind.com, think about that for a bit. When they're uploaded, Armand takes them off and he posts them on there. So you go to webinars and they're just in chronological order at the moment. I could do with tidying up, but when they're posted, they're normally put on there. Okay, that wasn't a question, but okay, I got you, Abdisalam. Thank you very much. Richard, good question. You hear a lot of people stating the news is already priced in. How true is that, not taking into account 3-star news, NFP, etc.? You know, there is a certain, you're right, Richard. I think most of the time that is the case, and that's where, you know, that's why we get these extreme moves. Everyone thinks, you know what, we're expecting this. That's a high probability. If you go to, like, for example, if you go to Fed, I think it's called fedwatch.com, you see the probability of the next rate announcement. So it assigns a probability like 93% no change, or 83% quarter point cut. Where it gets interesting is where there's a balance, and some people say it's 50-50 or a 60-40. It's like, you know, it could go one of two ways. That's when it's not priced in. When some, you know, there's equal balance either way, that's when you get the kind of the real reprice scenarios. But most of the time, yeah, you know, because most of the time the approach of the central banks and all this type of stuff is to not really scare the market too much. So, you know, you don't necessarily get these kind of unusual things out of nowhere because it just spooks the market. They like the market to be informed and stuff. So, yeah, to a certain extent, you're right, and that plays to our advantage when we're bracketing those algos, or when we go, this is all priced in. We've got a bullish response. And now we've got a reversal because, you know, everyone's expecting it. They got what they expected. And then price action doesn't align with that. That's when us as price action traders can really get on that type of stuff. So, you know, yeah, I agree with you to a certain extent, but not always. And actually plays into our hands. Okay, Leslie says, what is an ignition bar? Leslie, I will pretty much, it's basically a bar that's bigger than all the others. So it's a wide range bar, normally with high volume, directional, closing at highs, green bar, closing at lows, red bar. If you go, say, to my website, have a look, I've got loads of stuff on momentum ignition. That's the kind of heart and the trigger point for many of those type of trades. Okay, so Roy, with Fed out announcements tomorrow, what are your recommendations for trading the US 30? I think, you know, at the moment, man, there's so much other stuff that's just in the mix. It's like, no, everyone's like, oh, Fed, you know, when they've got, it's almost like a periphery thing that stuff's potentially happening. I think you've just got to, at the moment, it's a de-risking game. You know, we're not in a game where we're trying to be extra smart here in this particular environment. As well, I was in two minds about doing this news thing because it's a very unique environment right now. And there's all sorts of other things that can come out. There's all sorts of other headline risks coming out. I would just, you know, after he's shared strategies for trading news, I'd be sitting out a lot of the time, and especially in this environment, letting the dust settle and trying to find the high probability A to B stuff. And I know I've just shared strategies with you, but it doesn't mean you deploy them all the time. I think there's a time and a place for going, you know what, it's noisy. I'm going to wait and I'm going to see if I can find something, some sort of drive and a pullback. I'll take that. If I can find, you know, some sort of reversal, sort of trap, I'll take that. I think it's just risk I don't know how experienced you are, Roy, and where you are on your trading journey as a developing trader, but a lot of this is capital preservation. And let me just check this. I will read the question in a moment. So yeah, oil inventories as well. Let's see how it goes. Yeah, I'm gonna stick to that. I think just staying out at the moment and being very mindful of additional headline. There's something going on that we are maybe not privy to yet. Silver's a real big alarm bell. Gold, big alarm bell. Dollar's now going wild. There's lots of stuff with the yen. There's something that's trying to come out that might become clear. Maybe a fund's blown up somewhere that we won't know until later. You know, maybe it's all explainable away with simple macro stuff. I don't know, but you know, we are specialists in repeatable patterns, right? And sometimes they repeat daily, sometimes they repeat monthly, sometimes they repeat once every so often, and we get kind of these unusual scenario events. But when we get unusual patterns, unusual moves, often the play is to step back and say, "Oh, do you know what? Let me just calm this thing down. Let me just wait and see. Let me just take a few days back to see how it settles out, to see what really kind of you know, how it all unfolds and how it all unwraps." And I think that, you know, often being self-aware enough to do that, depending on where you are as a trader, is often the way. Okay. You can see well, I am kind of pausing stuff. So I'm balancing, like, I want to share stuff with you that I think is, I don't know everyone's personal circumstances. I'm there, I'm kind of qualifying some of the risk with stuff, but I'm also, I want you to stay in the game as long as possible. And I know that the way to stay in the game as long as possible is to manage the risk and stay defensive. But I also know that if it's working for you and you're more experienced and more seasoned, the name of the game is to put your foot on the throttle. So I balance those two things without knowing exactly who's asking the question. So you forgive me if I'm in two minds here. Okay, Jangir says, in your trading, how do you factor in the big players when you're placing your trade? As they are the ones that move the markets. They are indeed. What steps or strategies do you use? The retail trader, in most cases, the last one to the party, as I have found several times. Jangir, we never really know. And you could use something like, you know, the Commitment of Traders report, which Jason Shapiro is an absolute expert on. You can have a look at his YouTube channel, which is Crowded Market Report. So you know for sure then how the players are positioned. But, you know, I look at price, and I look at velocity of price, I look at direction of price, I look at you know, that to indicate who is moving money around, who is interested. You know, if we've got a big drive like we've had in dollar, like we've had in gold, you know, I'm like, okay, someone's putting some money to work here. We don't know why or what, but how do we use that to our advantage? And so, you know, I would always look and say, what's the magnitude of the move? In which case, someone's moving money around, I'm interested, as opposed to it sitting there doing nothing. So we never know for sure, you know, unless you're using the Commitment of Traders, you know, what the big players are potentially doing. But this is where we think about traps, we think about momentum, and we look at context, and we calibrate to context, and we decide then what strategy to kind of use. You know, and also the thing is with, you know, big players aren't always right. You know, the average hedge fund does not outperform the S&P 500, which is why we get some of the things we talked about before. A lot of people position for this. A lot of people buy the good news, and it reverses and they get trapped. So I'm not even so sure that actually a lot of times, you know, the big players per se are doing a better job than us, because a lot of them aren't. You know, we've got a lot of headline hedge funds that are doing fantastically well, fine, but a lot of the time these guys aren't really that great. But they leave marks on the market. They kind of move stuff about. So we'll see. Paul says, thank you for the seminar. You're very welcome, Paul. Danielle says, it's possible to view the recording of last Tuesday's session. The link on the Pepperstone website doesn't work, does it not? Let me make a note of that, and I will ask them to fix it. But if you go to my website, which is Traders Mastermind, it should be on there if it's up already. But Armin's normally pretty good at doing that. Richard, great information delivery as usual. Thank you, Richard. Mark says, what's your preferred platform to get instant news? X, or previously Twitter. A couple of guys in there I follow, like I've got to say the Pepperstone analyst, Mike Brown. Of course, he's very good at distilling some of this stuff. There's a guy called Walter Bloomberg who releases pretty much instantly the news that comes out. And you don't really want opinion attached to it, you just want the news. And then later on, you want to say, well, how do people perceive this? And then you kind of line up with price. But X is really good for that type of stuff. Okay, Rhino Trader. I love that name, mate. Thank you for today. I think I've gained a different approach to news now. Unfortunately, I missed last week's webinar. I can find it. Yeah, if you go to my website, I think it's up there. I'm saying this, but if it's not there, it will be when it's ready. You can either go or Pepperstone will email it to you, or it'll be up on Traders Mastermind in the webinar section. Shall I check? I think I will, because I keep telling you this, and I don't want to give you false information, guys. Traders. And while you're there, you can sign up for my daily email. I write all sorts of funny stuff. Yeah, there you go. Did we do that last week? Yeah. Failure and trap-based models. There it is. Webinar section. Are indices safer to trade than FX? It depends, Peter. It depends what sensitivity that asset class has to the news. So at the moment, like the dollar is, everyone's looking at dollar, everyone's looking at yen. These are super wild. So I'd say no. I never thought I'd say the day something like Nasdaq's maybe a slightly less volatile response to some of this new stuff. But this is where a little bit of macro knowledge helps, because you've got to understand. You don't have to, of course, but I think it helps to understand. Okay, what's driving? Why is this news important? What's useful about it, and which markets are likely to move the most from it? And there's no real safe way to trade news. You want to find something that's liquid, that's got reasonably tight spreads, and is maybe the second tier sensitivity to the news as maybe the first tier. So interest rates all going to bet the dollar, that revalues the dollar, which in turn supports or not the equities, and then obviously knock-on effect of how that helps companies with lower borrowing costs or higher borrowing costs. Actually talking about this, there's something that I used to do a lot with when the mining sector. God, oh, man, this is embarrassing how long ago this was, but the mining sector, I want to say, oh God, it can't be that many years ago. A long time ago, the mining sector used to be really, really active, and used to have these like Rio Tinto, Xstrata, BHP Billiton. I think some of these delisted now. Anyway, quick story, I promise. These would move like massively, and they would be super aggressive. But often you could trade the second tier miners, what they call Kazakhs, all coming back to all these second tier miners that were smaller companies that kind of would ride the coattails of that. So if you don't want to go right in the cold face of extreme volatility, look for stuff that's still impacted by the news, but less so, and maybe trade that, because then you get a kind of dampened aspect of volatility. So I'd watch these kind of big miners ripping off and doing stuff, and then I'd kind of look at the second tier effect that were a little bit slower, and it just kind of slows things down a bit. Okay, let's run through these. And he says, thank you, Mark. It's really interesting. I have a question. Do you treat headline volatility differently from scheduled releases, e.g. surprise comments? And what's the playbook action when that happens? That's a really good question, Andy. Yeah, I do. And I from a psychology perspective, I make sure I'm not rushing. So most of the time, that's going to be the post-news playbook, i.e. what's been said. Has that changed price action? Is it perceived as bullish? Is it expected response, unexpected response? If we get expected response, then I'm into kind of saying, what's the price action? Are we now into a grinding trend? Okay, bring out the trend playbook, the momentum playbook. Is it unexpected response? Okay, great, trap playbook. Let me I might have to short into lows so I could take advantage of that. But it's just being careful not to rush, because the amount of times you lose money just by rushing, thinking you spotted something, and you're the one getting caught in a damn trap. Rowie, great as always. Thank you, pal. What's your thought on setting VWAP volume profile on data releases and play as a pullback? Yeah, I think that's great. Can only include so much, Rowie, but you're on the ball as always. Anchored VWAP. I'm not a huge fan of volume profile, but I know people use it to with good results, so fine. Anchor the VWAP at the news release point. Very good point, actually. You anchor it there, and as price kind of goes up, often it will come back and retest the VWAP as a bounce point. The reason that works or can work is that very often that's a point where there's been a reprice and there's a buy algo kicked in, and they will reference their buying efficacy, value, price they've got based on when they started the buying. And if they're starting the buying after news release, the anchor point is going to be there. Yes, good. That makes sense. Rhino says, didn't get any emails with replays, even though I am registered. I'm not sure why, Rhino. Some people said this, and I don't know why, pal. Some people get them, some people don't. All I can say is, check the. You know what I might start doing, okay? Because I know that I don't know whether it's a bug or whatever it might be. I'm gonna on my daily email, when the replay's up, I'm gonna add it in the footer links, so you'll always get, whenever I get it and it gets processed and it's checked and all this type of stuff, whenever it's there, I will add it in my footer links to the daily email. I'll change it there so you can always access it from that. I'll make a note of that. But Pepperstone, I think, I don't know if it's a software they're using with GoToWebinar or whatever, it does go out, but I know some people say they don't get it. So let me just make a note of that, because I know that for whatever reason that is happening. Hopefully that fixes that. Okay. Victor says, any additional hints from the chart on whether the reversal past 75% is legit or not? No. Well, I say no, but I think you play it purely as you just frame the trade and go, you know what, my risk is that, and I'm prepared to accept that multiplied by my size. There's my first target, and you just play it purely like that. Now, you want some kind of excursion away, because you want the spring to kind of have some sort of momentum to be able to snap back. You don't really want it just flicking about, because often it just flicks about, comes back to where it was, and nothing happens. You don't get you need some momentum. So I guess if I adjust my answer slightly, would be some kind of momentum that's rushing back towards that point where the price came out, and you're kind of using that and saying, okay, and I'm framing it with the 50 and the 75, and I'm using the momentum and the trap, and I'm kind of just saying, okay, what happens. Roby says, or as a magnet back to mean reversion. Oh yeah, sorry, with the anchored VWAP. Yeah, so either extending out as a magnet back, or you're pulling back to the VWAP and a bounce off. Yeah, that makes sense. Thank you, Beth. Thank you, great webinar, she says. Definitely gives some valuable insight into how to structure my trades around the time of day and news events. Much appreciated. You are very welcome. Marinus, I like it. I often trade news. I usually wait for price momentum to fade before taking a position and let price fill previous orders. As time price fills all previous orders and goes back to the opening level, other times price reverses again at the roughly 50% level. Why does price sometimes fill all previous orders, but other times it reverses at the 50% level and not fill all previous orders? Okay, I think what you're saying there, Marinus, is, and it might be because I've rushed through the question, is that it's very, okay, here's the kind of the microstructure of what happens in news. If you ever watch level 2, the book goes thin. When someone responds to the news and they want to buy, they sweep a lot of that thin order as the offer, let's say. So they sweep the offer, they hit that, so they lift the offer, and it moves the price quite a lot. And what often happens is price is now trading way up here, but algos are kind of a little bit cautious. No one's come in to fill that level as the price has traded up. So you might have single digits, whereas before you might have 100 contracts, 1,000 contracts. Now you've got 1, nothing, 2. And so it doesn't take much for it to sweep back down again. So very often you have that scenario where it's just a very, very, like a liquidity vacuum, I call it, on the order book. It's very difficult to trade. And so often you get that coming back, and it's, filling levels. But why it sometimes stops and doesn't go back all the way is very often someone then will come up and just slam a big order in the book, and it will kind of fill up from there because they want to buy it and they kind of don't want to chase it. And very often that acts as kind of support because it's so sensitive to stuff like this. Beth says, I don't normally trade around news events. Okay, just if you've got to explore that, Beth, be super careful. I know I've said it multiple times before, but above all else, stay in the game long enough time to grow. That's the name of the game. But yeah, try on demo, guys. You know this. Pepperstone offer a demo. Try on a demo, play around. See if it's right. This type of thing's right for you. If Jerome Powell gets forced out, how will it affect the markets? I think that, well, we know that this is a macro question, isn't it? I'm definitely not a macro expert, but we're pretty sure that whoever comes in is going to be amenable to Trump's request for lower interest rates, which should, if you technically perspective, that's going to boost our equities, right? There's going to be bullish for equities. It's if that is the case, and there's no reason to think it's not the case, right? Because Trump said whoever gets the job has got to lower interest rates. It's kind of like you're independent, but you're not quite independent. Can someone manipulate trade market? Isaac says, yeah, mate, of course they can. And often you see that sometimes pre-market where the order book will go thin and it will wick around. People will be dossing about. Manipulation doesn't go as along as on as much as we think. Under certain circumstances, yes, but there's got to be a big payoff for it. Think about why. Let's reverse engineer. Why would you've got to have a big payoff if you're going to spend money manipulating the market or a higher time frame doing that? There's got to be a reason for that. And what's the reason for that? Sometimes you might assume that to be the case if they're trading options and there's a strike price and a market maker is due to be out of pocket by a lot, so they can spend 20 million potentially moving a market and they save themselves 80 million or whatever. I'm making numbers up. You can understand the logic, but there's got to be some sort of payoff for any manipulation if you believed it to be manipulation, and that's the way I look at it anyway. But I don't overthink this stuff. I'm like, okay, listen, I just trade price. If I'm wrong, I'm out. I take my loss and move on. If I'm right, great. Next trade. Had to miss tonight. Watch the recording. No problem, Gary. Thank you. When we click the previous recording available link via the email sent, it takes me to the trading website. Kush, is this Pepperstone's email? They must have the link wrong then. Apologies, and I'll give them a shout and we'll get that sorted. But you can, wait a second, you don't use my website, do you? You don't mean that. Failure and trap-based models. Yeah, you can go out and Traders Mastermind, and it's definitely on there. It's definitely on there. Great discussion and style. Thank you, Victor. Mariner says thanks. 2 more questions, and we're good to go. When news comes out, would it be worth waiting for day 2 when the quality of news has been digested by the bigger players and key levels have been defined? Yes, that's an absolutely great way of trading. So day 2 play is absolutely really good, and it's one of a solid playbook to have. Solid. It could be news driven. It also can be driven by just a kind of a trend type day. Yeah, and you take your levels from day 1, you extrapolate them from day 2. And you very often have tendencies, like if a market closes in the upper 10% at that extreme range, if overnight it's drifted lower, very, very often it's going to retest that high. There are some tendencies and probabilities that work very, very well with day 2. So if you want to calm things down, but you still want to be exposed to some of the impact of news, then the day 2 focus is a good way of doing stuff. Thank you, Mark. That's a good point. Rory says, really great webinars for the beginning of the year. Good. I'm glad you enjoyed your January, ladies and gents. We're back next week with more juicy stuff to help you with your trading. I hope that's helped. Please keep the risk managed, whatever you do, because the name of the game, like I say, is to stay in it for as long as you possibly can. You can't do that if you blow up your trading account. So keep things small, keep the risk managed, and enjoy the process, enjoy the journey. See you guys next week. Thanks for the questions. Great questions as always. See you guys. Bye-bye.